22nd of August, Tuesday, European stocks rolling over a little bit, but still positive. Look at that. We're up on the day. Technology's doing pretty well. The mining stocks are doing pretty well. That's the US story, and that's the Chinese story, basically being represented in Europe. The countdown to the close, it starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So European stocks off their highs. Volume still a little light. We're up by 0.7%. Technology and basic resources, technology in the mining sector, those are the two areas that you want to focus on. Ubisoft is one of the main reasons why the tech sector is doing well. This is a games maker, competes with Activision Blizzard. It looks like it's going to be the big beneficiary coming out of the latest deal that potentially could be done between Microsoft and Activision Blizzard and the UK regulatory authorities. Ubisoft could be the big beneficiary, as a result of which its stock is up by 9.26%. The mining stocks have done a little bit better today. I'm still scratching my head about the move that we saw late in the Chinese session today, but it did spill over into more positive sentiment here in Europe. Many people speculating that the Chinese government, the Chinese authorities were in supporting the market. Whatever the reason, mining stocks, Alex, tracking a little higher.
All right, well, here in the U.S., Guy, you're seeing the S&P kind of fade an earlier rally, but we're still up by 0.1%. NASDAQ 100 outperforming, but just how long that's going to last. We've seen some big intraday swings. You can maybe chalk it up to options and short gamma trading, but nonetheless, watch that over the next few hours. Just breaking a couple things down. DIX, we were just talking about it, terrible, down 24%. They had 1/3 of their margin decrease was due to theft. That's pretty terrible. So they got some stuff they got to sort through. 10-year yield goes nowhere. The dollar bid against the yuan. This is despite a stronger fixing rate from the PBOC earlier today. They're really trying to get a handle on any shorts also in the market. So watch that. What I do find interesting, though, Guy, is that Charlie McGilligot of Nomura was talking about the equity rally and say, look, if we don't get something to confirm the bear steepening in the bond market, and if Nvidia continues to just fire on all cylinders, the window for a sell-off for equities is going to close. And then you might have a situation where you're going to chase the rally, and that CTAs are going to have to get back in and chase the rally as well. So that's really I'm truly fascinated in that thesis, Guy.
Absolutely. The momentum story has been really interesting to watch this year. But how quickly it's moving around, I think, is fascinating. But the momentum with tech has been one of the more constant themes. Tech is different, definitely different on either side of the Atlantic. If we have tech over here, it tends to go over there. Look at ARM. But the tech that we do have trades at a significant discount here in Europe. So what do you do? Alex is talking about chasing the tech rally. If you don't chase the tech rally, does that mean you buy Europe? If you are chasing the tech rally, does that mean you're ignoring Europe? Even within the technology space, there seems to be a difference of opinion across the Atlantic. So European tech is getting cheaper and cheaper. So this is the European SOX 600 technology price index versus the US information technology sector. That's the IT sector. The two are so different, and they're being treated so differently by the market. It is fascinating to watch. We are now at levels we haven't been at these kinds of levels for a very, very long time. And we are well below the 10-year average. Even European tech is not loved at the moment. It's just amazing to see this narrative, this gold rush, this AI gold rush that we're seeing in the United States. And Alex, you do wonder what's going to be the big event this week. Is it going to be Jay Powell, or is it going to be what happens with those Nvidia numbers? If the Nvidia numbers are good, do you chase the rally?
Yeah, I also wonder how much of that European underperformance, though, when it comes to tech is Adyen, which has just gotten totally just crushed in the last few trading days.
It's been going on for a while, though. That's a short-term story. It's been a long-term and ongoing thing.
But I wonder if that's also contributing, if you pair that with Nvidia, if that's also contributing to even more of a rollover in European tech. Anyway. Let's ask the panel. The question of the day is, do you chase tech? It's also a way of asking, do you chase tech? Do you sell Europe? Is it a value growth situation? We're going to break it down now with Bloomberg's Ed Harrison and Jackie Davalos, who joins us as well. Edward, let me start with you. You're on set with me here. Do you chase the tech rally and sell Europe? Is it a value growth thing?
Yeah, I mean, it depends on what your time frame is, because obviously the United States is outperforming economically, and so there might be a little bit more juice left in this. I think, Charlie McGilligot, who I like very much, I think he's spot on in the sense that, if you look back to March, April, If you weren't fully invested in the S&P 500, you would have been underperforming. And those people are chased into this rally, and they're still chasing. So there's that time frame. But over the longer time frame, what we're looking at is a massive overvaluation in this sector. If you look at Nvidia as an example, trailing earnings, like 225 times trailing earnings. We're looking at 65 times, or I think it's actually 57 times forward earnings. You look at Tesla, the same thing, 65 times forward earnings. That's Microsoft. It's circa 1999. Microsoft was trading at 65 times earnings in 1999. So we're looking at dot-com level overvaluation.
Yeah, what we don't know yet is how many of these companies are going to fall by the wayside and how many of them are going to become the new Googles. That's the bit that we can't figure out yet, Jackie. Are we going to get the answer to that question when we get Nvidia's numbers? Is the answer going to be there? If they exceed expectations, then we're off to the races. If they don't, then this thing crashes and burns.
It'll be a certain test for the market. With Nvidia's numbers, the market's expecting about $11 billion in sales. That's over 50% what they brought in sales last year. A lot of that growth is coming from the data center unit, which houses all of these essential graphics chips crucial to powering AI tools. Now, you're expecting to see those sales trickle through, but it's that demand. How much of that is actually starting to come in, flowing through the numbers? Most of that is actually coming from smaller startups as well. You have the big tech giants piling in, Microsoft and Tesla also looking for some of these chips. Across the board, everyone's trying to really pile in, but Nvidia can't be the only beneficiary. Certainly, they dominate this market, over 80% of market share. Yeah. So you have other competitors really looking to chip away at some of that. And so, some would say that maybe this is overvalued, but I think we're just kind of getting started.
Well, interesting to that point, Guy, because that's where I feel like the Adyen story, and I know that they're different companies, but may come into play. Adyen was valued at what, 54 times projected earnings before they disappointed, and just how quickly they've re-rated. Like longer term, again, okay, but short term, are you just overvaluing them?
Well, it's such a tricky. Trying to figure out a valuation is so tricky with these companies that have such long projections. Yes, AI is going to be massive, but putting numbers around that is really difficult. Trying to get a valuation around that, a lot of this is hypothetical. Market's comfortable with that when rates are low. Is the market going to be comfortable that if rates stay high? It becomes a much more difficult calculation.
Right, exactly. So then that leads me to you, Edward. Like, are we seeing the world where like Nvidia drives yields or yields drive Nvidia to that, like that correlation?
Well, yeah, I thought it was interesting that we were showing the S&P somewhat retracing its move. That was also at the same time that we saw yields going up. Yields were actually down earlier today. I think that the real yield increase, we saw 2% on the 10-year tips yesterday. That is driving a lot of what we're seeing in the markets. It's not just driving risk, but it's also driving mortgage rates higher, et cetera, and it's going to have a real impact on the economy overall. When we think about Nvidia, I think that I look at Nvidia sort of like Intel and Cisco. Cisco more so in circa 1999. The company is so large in terms of its market cap to be able to trade at 60 times earnings. Really, they've got to do everything just right. So if you really want to get into this space, as Jackie was saying, there are other places to look as well.
Jackie, does anybody talk? You cover this space. Do people talk about 1999? I don't hear that conversation very often. Ed mentioned it just a moment ago, but is anybody talking about the comparisons between the two?
Absolutely. We actually just did a survey a few weeks ago that basically polled Bloomberg terminal users on whether they saw similar signs of what we're going through now in this tech rally to previous tech bubbles. And you'd be surprised because over 50% of the about 600 respondents that came in with their answers, half of them think that we aren't close to the bubble bursting yet. So that seems to reflect just a really big bullishness that there are still more, this has legs, and we have a little bit more to go before we start to see the real warning signs show up.
Yeah, I think also in 1999, that's when Guy was wearing Birkenstocks with socks. I'm just saying, like, it all goes back. It all circles back.
You may be right.
I know. Jackie, then last question to you. What are you most interested in when Nvidia crosses? Like, what's the number that's going to be the signal to you?
Data center unit sales. I mean, if that's really where we're going to see this AI gold rush show up, they have to deliver on that because they really are setting the standard here for those AI beneficiaries coming through. You have the ARM IPO also kind of tying into that because they're hoping to really gain some of that AI momentum. Their chips business is totally different than Nvidia. They don't really have a lot of that graphics chips infrastructure that they need for AI tools. And so if you kind of see where Nvidia is able to set the standard there with its data center unit, I think it could speak a little bit more to the potential ARM has going forward.
Really fun combo, guys. Thank you so much. Jackie Davalos and Ed Harrison, thank you both. So coming up, more on our question of the day, do you chase tech? Bailey Wakefield, Aviva Investors multi-asset portfolio manager, coming up next. This is Bloomberg.
We had a real concern previously that Microsoft would be able to control the way that that market was going to develop. What we see with this new deal, and we will have to test it carefully through our review, but what we see from the announcement today is that rather than Microsoft being able to control how those cloud streaming rights are used, that control will shift to an independent company.
That was, of course, Sarah Cardell, the CEO of the UK Competition and Markets Authority, talking about the almost unprecedented reopening of a deal, in this case, the Microsoft-Activision Blizzard deal. Microsoft says it will sell the rights to all current and future Activision games released during the next 15 years to Ubisoft. Ubisoft stock having a cracking day on the back of this. To kind of understand exactly how this all works, let's go to Berlin now and bring in Aggie Cantrell. Aggie, just walk me through why Microsoft has had to do this and how close we are to the point where this doesn't make sense. This is a pretty big concession that they're making here, right?
It is a huge concession, Guy, because a lot of the appeal of this in the first place was because of the nature of the deal that is being struck being part of this bigger push towards cloud streaming for gaming. It's a big business and it's an ever-growing business. So the real fear is that Microsoft, with already its capacity around cloud infrastructure and also its focus on Xbox, that with this as well, it would be a real risk that they would essentially be able to lock up a nascent market.
So, Aggie, I guess I'm also curious as to why they did that. Like, what do they keep? If they're basically going to be selling everything over 15 years, like, what is Microsoft from Activision left with?
It's essentially about the potential for this going forward, and what they're looking for is essentially this infrastructure that they will have. And this is also a deal that is sort of the Microsoft playing the long game as well, because it is a 15-year plan, but also they have a lot of this infrastructure themselves as well. So yes, there is this 15-year period, but really in the long run, this is supposed to be something that Microsoft is going to be investing in.
How significant is it that the UK has had another look?
It's really significant, Guy, because it was something that other districts or other regions were also paying attention to, but seemed to be relatively lenient in comparison to the UK. The UK were really the ones who were going to be taking them to task on this. And when we were looking at the US and the EU, it seemed like there wasn't really as much of a concern. But this is now essentially showing that the CMA, who are really concerned about this deal, they have said that this is significantly different from what was first presented to them. They, of course, are also saying that this isn't just a green light. They're still going to go through the review process, but come October, it seems like this is likely to go ahead.
Do you think that there are other deals then that could also be revisited? Like, is this a nice template for other big M&A deals that the CMA might not like?
Yeah, exactly, Alex. I think something that's really interesting about this is actually what it means for the broader deals market, that a lot of big tech, there has been, especially in the EU, we've seen a lot of criticism around big tech players locking up these deals and the risk of antitrust in the tech space. And I think something like this might actually show them, you know what, if you really commit to this, if you commit a huge amount of your resources, of your legal resources as well, and really push for deals like this to happen, you can make them work. And so I think that this is sort of a signal to the rest of the tech market that actually there may be deals to be had.
Is Ubisoft the big winner here?
I think in the meantime, it really seems like Ubisoft is the stealth player and is really the big winner here. It seems like we saw Ubisoft rise today off the back of this, and also the French gaming company is itself an interesting player in the market. And I think that it will be interesting to see what they do with this Activision product.
Hey, Aggie, always good to see you. Always our fave. Aggie Cantrell, thank you so much for joining us from Bloomberg. Okay, coming up, we're going to take a look at the markets again. Back to our question of the day. Do you chase tech here or do you do something else? Look at Microsoft, for example. This is Bloomberg.
I'd say like over the next days and weeks and probably over the next month, yields could stay high for quite a bit. But the pressure in itself is on the economy right now. And, you know, if you think yields are going lower over the next 6 to 12 months, then tech could be a good buy here.
A few ifs and buts in there. Kelly Cox, eToro US investment analyst, speaking to Alex and I in the last hour, takes us back to our question of the day. Do you chase tech? Do you chase this rally? Bailey Wakefield, Aviva Investors multi-asset portfolio manager, joining us now to have a stab at that question as well. Bailey, what do you think? US tech took off yesterday afternoon, fading a little bit today, but the market still seems to want to come back and buy, particularly in advance of Nvidia numbers.
Absolutely. I think that's a question a lot of investors are debating at the moment. How can you separate the hype from the reality and whether this could be another dot-com bubble? But you can't ignore the fact that OpenAI.com, where you can access things like ChatGPT, is currently ranked as the 17th most popular website in terms of traffic, and that's in front of websites like Netflix and Yahoo. And even though there might be some exuberance at play in markets, it's not to say that AI won't bring long-term productivity gains for all types of companies and sectors in the future. In some companies' earnings reports, we're seeing quantified revenues or cost benefits due to the application of AI. So the evidence for that support is building.
But Bailey, do you feel like the price action, though, is signaling anything fundamental, or is this going to be a positioning story into Jackson Hole and into Nvidia at this point?
Sure. So, I mean, we know that some of the valuations for these companies are quite stretched at the moment, and some of that might be playing through. That pullback might be what we're seeing with Nvidia today. We do recognise that there could be some like a path to continued profitability in these companies, and we've seen a material change in some of these companies as well in terms of the profitability and the willingness for companies to reduce costs. And we haven't really had that conversation before. So it's going to be something that investors are going to be looking at, especially going in towards the end of this week, and they'll be focusing on Nvidia's earnings tomorrow.
If I'm a European investor, is there any reason to keep my money at home, or should I be moving it all to the United States? Not all, I joke, but should my focus be the United States right now?
It's a great question, because it does feel that some days we are seeing markets move relatively in the same direction as US markets. They're moving in line with US data releases, but just with a different level of beta. So it's definitely that the US is leading the way at the moment. In terms of...
No, go ahead, Bailey.
Sure. Yes, we do have a long position in US at the moment. We've seen a slight reduction in risk appetite over in August due to seasonality, the Fitch downgrades, some of the Bank of Japan spillovers, Treasury supply. But over the medium term, on a taxable basis, we recognise that late cycle dynamics are still at play, and we're still pricing that soft or no landing scenario.
Bailey, in terms of European equities, though, like I know things are cheap and they can always get cheaper, but the discount for European equities versus the U.S. is double sort of what we normally see at this point. How much wider can that go? And do you think that European equities go up to meet it, or S&P goes down to meet it?
Yeah, I think there's some factors there that are playing in. One is the spillover from China. We know that Europe does have some tight trade links to China, so any of the news that we're seeing there in terms of poor data is definitely having a read through, and we're seeing the impacts. We are also seeing some of the benefits of tech at the same time as well. We're seeing markets move in a similar direction when we're seeing some of the US tech markets do quite well. So Europe has been an area that's maybe plateaued a little bit more recently. I think it's a little bit more tied into China, and the decisions that happen there will have quite a big read through.
I'm going to ask a question which I asked in the last hour. Can I believe in higher rates that are going to be higher for longer and in the tech sector at the same time? Can I hold those two thoughts in my head, in my portfolio simultaneously?
Yeah, sure. I mean, it's a tough one because I feel like in history, we wouldn't have even been asking that question. We wouldn't have even put those two ideas in the same sentence. But going forward, we are envisioning an environment where we're going to see higher for longer rates. It seems like the tech market isn't really pricing, isn't linked into some of the higher rates that we're seeing coming through. It seems that tech markets are kind of looking through that and looking through to the side of rate cuts. So that relationship has changed quite a bit over time. So we can see an environment where that could be the case.
Bailey, to that point then, where in the bond market, Europe, UK, US, would you buy?
So we have a few different positions on at the moment. We have a long position in the US 30-year, does have some defensive properties, and with the moves more recently, we think that the moves could be more asymmetric to the downside. Similarly with gilts, again, seems quite asymmetric given the moves and with some possible hawkish surprises priced in. And while the bank rate may continue to rise, we believe that inflation has peaked and the evidence of policy traction will increase, and the signs of labour demand loosening are encouraging. And balanced against that, we have underweight positions in Japanese government bonds.
Right, of course, sort of waiting for any kind of normalization there. Hey, Bailey, thanks a lot. Bailey Wakefield of Aviva Investors. Thank you. And you're almost done with your day. What, like a few minutes to go until the close?
That's what we're counting you down to now. European equities a little bit higher, as you can see. We're off our highs. We faded a little bit this afternoon, maybe not as much as we're seeing over in the United States, but we didn't price in the early move either. So we're seeing mining stocks doing relatively well. We're seeing technology stocks doing relatively well as well. Ubisoft is trading higher. It's up by 8.66%, 8.6%. Does seem to be maybe the stealth winner, as Aggie Control was putting it, of this Activision deal. Anglo, the miner, tracking higher as well. It's up by 1.62%. Miners generally, Glencore is up as well, doing relatively well. Adyen is down again today. That stock continues not to be able to catch a break, so that's where we are continuing to see some weakness. But most of the sectors have been spending most of the day in positive territory. The kind of the mood music out of the United States and out of China actually coming together today in Europe to produce a more positive picture. Hasn't been that way for a while. Anyway, the close is coming up next. This is Bloomberg. Rolling over a little bit as the day has been progressing. That's been the narrative. European stocks generally more positive today. As I say, you had a kind of positive story coming out with a late-stage rally out of China, which has helped European stocks. And then we factored in the late-stage rally we saw on Wall Street yesterday, the two coming together in Europe to produce an early bounce that, as I say, has subsequently faded. So we're up. London's lagging a little bit, only up by 0.2%, but on the continent we're up by, let's call it 0.5%. Stock 600 looks a little bit like this. We are looking at a session that started off quite well, and then we faded. There you go. Move higher, move lower. It's nice symmetry to that, though, isn't there? Still up by around 0.7%. But we're now looking at kind of 440s. We're at 451.94, 85 at the moment. Again, some interesting levels. Keep watching what is happening here. From a technical point of view, we're kind of flirting right on the edge of potentially a move lower. That seems to be the technical analysis narrative that is developing. Single stocks, I think, are quite interesting. Tech's done well today. I seem to have managed to bracket the techs around Anglo-American. But Ubisoft, as I've been talking about, big gainer out of the Microsoft-Activision story. Microsoft, ST Micro has done well. The chip story getting a boost. This is the kind of the Nvidia rally story that we've seen progressing yesterday, fed through early on into Europe. ST Micro up 2.61% on the back of that. The Chinese story kind of has helped the miners out today as well. And you've seen that reflected in Anglo, you've seen it reflected in Glencore. I'm not entirely sure why Chinese stocks rallied as aggressive as they did in the last few minutes of the session, but they did, and that fed through, and miners are the beneficiaries. So tech's done well today, miners have done well today. The US has feed through, the Chinese feed through. That seems to be the story here in Europe. What happens tomorrow? We're obviously counting you down towards Nvidia. We're watching what's going to happen there. We've obviously got the Powell speech coming up on Friday. Going to be hearing from Lagarde as well. I just want to keep flagging that Lagarde interview, that Lagarde speech as well, which I think is going to be interesting. Tomorrow we get a lot of data. And again, I think this is going to be really interesting, this data. Are we going to see the effects of higher rates starting to come in through into the service sector? This is PMI data. We get it out from France, Germany. We get it out from the UK as well. Are we going to start seeing the impact of the higher rates coming through into the service sector? I think that is going to be one story you want to watch out for. But then as well, are we going to start to see the impact of this really disappointing Chinese narrative feeding through into that data as well? There's lots to digest. I think these PMIs are quite important. We're focusing on Nvidia, we're focusing on Powell, we're focusing on Jackson Hole. Keep an eye on what the numbers are going to be telling us. We're also going to get consumer confidence data out from the Eurozone tomorrow. So I think there's some actually quite useful numbers that are going to be generated tomorrow that I think cannot be ignored. I appreciate they may be kind of second division relative to some of the bigger events this week, but I think they're going to tell us an interesting underlying story, Alex, about what is happening here in Europe.
And also just the direction of travel. You mentioned China. Like, there are two really big unknowns that can affect those PMIs, China and also natural gas prices. And European natural gas prices are actually rallying on that labor issue over in Australia. So workers at a Woodside export facility could actually strike as soon as next month if a pay deal isn't reached tomorrow. Now, Woodside CEO Meg O'Neill told Bloomberg TV that they are making progress.
We're making good progress on the discussions. We're engaging constructively, we're listening and trying to really understand the areas of concern that our workers have. And I think the meetings are going well. So we will just continue to engage in a constructive and respectful manner.
But clearly, two risks that can kind of overlay the data for tomorrow. Jennifer McEwen is a chief global economist over at Capital Economics and joins us now. Jennifer, what are you expecting tomorrow? What's the signal you're going to take away?
Well, I think we're probably going to see more of the same from the PMIs, really, which is that they're pointing essentially to stagnation in the UK and the Eurozone, little more than stagnation in the US. So just a continuation of this soft activity, but not really the slump into recession that many had feared as tightening cycles, monetary policy tightening cycles gain pace. So soft economies, but not very, very weak ones. What will be really interesting will be to see whether the services sector has started to turn down as well. The manufacturing sector PMIs have been very weak for quite some time, and also the extent to which price pressures seem to be easing. There are output and input price balances within these PMI surveys. They've been coming off, but they're still pointing to high rates of inflation.
In terms of the data we're going to see out of Germany in particular, do you think we're going to see some concern, more concern, should I say, Jennifer, on what is happening in China? This is an economy that has significant skin in the game when it comes to what is happening with the Chinese economy.
Yeah, that's right. Particularly the car sector. Germany's car exports to China are relatively important. It may be a bit early to see a dramatic impact from the pickup in concerns surrounding Country Garden, the Chinese property sector more generally. So we may see more of that coming through in next month's PMIs. But it's certainly another factor that's weighing on the outlook for the manufacturing sector in the Eurozone.
Jennifer, what about rising gas prices?
Yeah, that's a real concern. Of course, the big issue for the Eurozone has been the dramatic fall in gas prices, and that has served to bring down headline inflation. We may start to see some impacts of that coming through on consumer confidence. It's really helped to ease the cost of living squeeze. So any signs of a renewed pickup, any evidence of renewed limitations on supply, yeah, that could be a blow for the Eurozone economy, because that's really been the one bright side this year, that gas prices have finally been coming down.
Jennifer, the Eurozone data is starting to show some cracks. Do you think those cracks are going to be reflected in what Christine Lagarde says on Friday when she speaks at Jackson Hole?
Yeah, well, she's certainly going to need to take a very cautious stance. We know that financial conditions have already tightened very dramatically across the advanced economies, but in the Eurozone too. And that credit growth, lending growth in particular, has really come off. Lending's falling in the Eurozone in a way that it's not in the US. So it's pretty clear that there are effects of tighter monetary policy coming through in the Eurozone. So she's going to need to balance the need to bring inflationary pressures down. Wage growth still seems to be rising in the Eurozone. There are a few signs of slack in the labour market, which we are seeing to a greater extent in the US. So she's going to need to be cautious on the inflation side, but at the same time very wary that they've already tightened policy quite a long way. And this is pretty much uncharted territory for the ECB to have policy rates at these kinds of levels.
Jennifer, do you think that the US and Europe are dealing with the same problem and the same trajectory now at this point?
Not entirely. I think it's much clearer at this point that core inflation is coming down in the US. There are plenty of signs that the tightness in the labour market is easing. Broader labour market indicators such as vacancies, job quits are clearly pointing to a continued downward trend in wage growth in the US. The ECB, though, doesn't really have that reassurance. The labour market is still very tight. It still looks like wage growth is going up. So I think that suggests that perhaps the ECB's tightening cycle isn't quite done, and that interest rates, once they've hit their peak, will stay there for longer than those in the US.
Where does that leave the Bank of England?
The Bank of England, I think, is probably somewhere in the middle. I think also in the UK, interest rates will stay at their peaks for much longer than in the US. We've probably got one more hike to go at least in the UK. Wage growth at over 8%, much stronger than in the Eurozone. So on the face of it, there's a bigger problem there. But I think it may be that the UK ends up experiencing a slightly deeper recession than the Eurozone, and that in itself will help to bring price pressures down in the end. But for now, tight labour markets again, very weak labour supply related to long-term sickness, NHS waiting lists. I think all of this is going to keep wage growth relatively sticky in the UK for now, and mean that the Bank of England can't ease off.
Which meanwhile, though, Guy, I mean, we have seen the data come in better. You know that, like, it pains me to say this, right? But GDP coming in stronger than estimated for the UK. So it's sort of like the longer, though, everything goes on and the longer it takes until we get to some kind of slowdown, it sort of pushes out those cut scenario. And you could be in a case where the Fed can cut more aggressively than the UK and Europe.
Yeah, the UK economy there's nothing good here. These aren't good numbers. They could be worse. I think is probably the sense of what is happening here. What I thought was interesting, though, this morning was that actually tax receipts are a little bit higher. So more people are being pulled in, paying higher taxes. That gives the government a little bit of room for manoeuvre. I don't know whether or not that's ultimately going to translate into tax cuts. There's not really much room for tax cuts either. So the catalyst to get the UK economy going, I think, is actually the missing piece here. It's not as bad as it's feared, but I think everybody's struggling to understand, and there are no easy fixes here, how you fix the UK economy and get it moving again.
Fiscal. I mean, fiscal, and that's one thing
but
that
that's
the US
problem. There isn't any fiscal room.
I know.
There isn't any fiscal room.
The UK doesn't have it. Europe is sort of like, let's go through all the rules and think about it and make good decisions before we actually put the money. And the US is like, shoot first, questions later when it comes to the fiscal policy of like the green transition. And like, I wonder if as we go forward, that's going to wind up shaping monetary policy and the differentials with the three regions. Absolutely.
Absolutely. The US economy is being driven by fiscal at the moment. It is being driven by government spending. If you take that out, maybe you look a little similar to what we're seeing over here. Jennifer, we've been hanging on for a long time. Thanks very much indeed for joining us. We really appreciate it. Jennifer McEwen, Chief Global Economist, joining us from Capital Economics. OK, let's check where European stocks have finished. A more positive session, as I say, more positive narrative coming out of China, more positive narrative coming out of the United States, helping European stocks get a little lift today. Tech's done relatively well today. We've seen some of the mining stocks doing relatively well today. It's not exactly a blowout session, and we faded as we come through towards the end of the day. Coming up, we're going to talk more about what is happening in China and what is happening with China's impact on the mining industry. The world's largest miner, BHP Group, warning of demand uncertainty. We're going to hear from the company's CEO next. Mike Henry coming up. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Kelly Steckelberg, Zoom's CFO, joining Bloomberg Technology at noon in New York. That's 5 p.m. in London. This is Bloomberg. So one of the standout stories out of Europe today, what's happening in the mining sector. BHP, the world's biggest miner, reporting its lowest annual profit in 3 years. I think last year it reported its highest. The company says the outlook for China is the area of uncertainty. BHP's CEO, Mike Henry, telling Bloomberg that the company is closely watching what is happening with China's struggling property sector.
It is fair to characterize it as a bit uncertain. Now, I would start by saying that there's actually a number of sectors in China that are going quite well. That includes green infrastructure, other infrastructure, automobiles, and so on. But the key sector, of course, that everybody's focused on, and which is very relevant to certainly to our business, is the property sector. Now, in property, we've seen strong completions up 19% year on year. But what's lagging is new starts. That's been recognized at the central government level. There's obviously policies in place that are meant to stimulate new starts, but they're not translating as effectively into changes on the ground as certainly we were anticipating, and I think some others were anticipating as well. So that's really what we're keeping an eye on over the next 3 to 6 months, is how effective is that translation of policy into practice. If we do see that starting to take hold, then we think there could be good growth momentum flowing from FY23 or calendar year 23 into calendar year 2024. Outside of China, I was in India about a month back. The energy on the ground there, the optimism is palpable. So we're seeing solid momentum in India. Of course, that's a big market for us for commodities like metallurgical coal and for copper concentrate. So overall, we're seeing India and China comprising about half of world GDP growth in the period ahead. And the other point I would note is long-term fundamentals for this sector and for BHP remain really healthy.
Yeah, Mike, we'd like to talk more about the opportunities there in India, because certainly that is a growing market of yours. I just want to pick up, though, on some of the points you're making on China. So, I mean, almost every CEO we speak with is uncertain over the environment there. There's certainly hope, let's put it that way. I want to ask you about what you're seeing across short-term pricing on many of your products in China. What's the outlook on pricing these next 6 months?
So, of course, it's going to depend a little bit on what happens with the overall economy, with demand for commodities like iron ore. There are some rumors of potential mandated production cuts in steel, but it's not like the industry there is starting with high inventories in iron ore or steel. So any cuts that would occur would very quickly start eating into those inventories. Now, obviously, if there was lower demand, that has implications for pricing. But one very important point to note is that the marginal cost of production across the commodities that certainly we produce is higher now than it was pre-COVID, naturally, given the inflation that we've seen in the external environment. So we expect that's going to provide a downside cushion on pricing at a higher point than may have been the case previously. In the case of iron ore, we're saying somewhere between $80 and $100 per ton is likely where the cushion kicks in, given what we've seen on the inflation front. And of course, from a BHP perspective, because we've done a better job in controlling costs than our competitors, we've doubled our lead as the lowest cost major iron ore supplier globally. That higher cushion means that our margins, relative margins, end up being more protected than might be the case for some others.
That was BHP CEO Mike Henry. And talking commodities to retail, this is like the perfect segment for me. We're going from one love to another love, is Macy's. We're watching that stock. Shares are slumping. They're down by about 12%. Yep, 12%. So it had a weaker outlook, delivered a 41% drop in credit card revenue and increased delinquencies. That's not a great picture. Bloomberg Technology co-host Caroline Hyde spoke with the company's CEO, Jeff Gannett. Caroline joins us now. Caroline, what was the most relevant thing that you got from Jeff?
I really think it is about uncertainty around the consumer. He said, look, it's not the right time to be optimistic on our consumer right now. They have been surprised, perhaps at the pace at which delinquencies have been picking up on their own credit cards. He says, look, we don't have bad credit out there. We still got a good kind of person that they're serving with their credit cards. However, look, the headwinds are building. I got a great quote from him really talking about how now the headwinds are stronger than the tailwinds. And we're seeing, the people having to start to pay off their student loans. He is starting to see a consumer that wants to be spending on, of course, experiences. Still a bit of beauty, and that's why Blue Mercury manages to outperform. But I think we can bring you those quotes from him really talking about when you look at these diminished overall tailwinds that they currently see in the market, there is this worry about the steadfastness of a consumer. That's why they've been taking such diligence about their inventory, cutting it some 10%. And we are seeing overall, therefore, some of the upbeat nature coming from analysts saying, look, they have managed to be pretty surgical, as he pointed it out, when it comes to stripping down their inventory and making sure that they've been making investments in digital to be able to drive that.
Yeah, so I'm hearing a lot of retailers increasingly becoming quite cautious. They're managing working capital a lot more carefully. They may be drawing down in terms of their investment expectations. How is that going to affect that digital push, Caroline? Are they going to be sort of pulling back on that a little bit, or is it still the main emphasis when it comes to spending money?
Still a key commitment. And that was what I wanted to see, because this is a company that actually, Jeff's saying, they don't feel they're sort of hitting the ground running as much as they could be on digital. They feel they've got the prowess. They feel that they've been investing, but perhaps they're not seeing those returns. Like digital sales down some 10%. That's largely an environment that we are in terms of a macro perspective. But they've just hired a new executive to be driving forward their digital focus. And they really feel that digital can continue to be an area that is healthier, is what he said, of where they are today. They think that the future of digital can grow more aggressively within the balance of the company. They see it as part of their growth vectors. Just think, in particular, they've got a marketplace, right? So this is how you go into a Macy's, but you do it online, and perhaps you get a far more broad remit of what you could be buying at Macy's. I think of, well, garments, I think of beauty, but actually you can go and get gaming equipment, consoles and the like, if you go to their marketplace. That's been a big driver of growth for them on Macy's. They're now starting to test that on the Bloomingdale's side of things. Is that luxury buyer going to want to access more brands in that particular online way?
Really great interview. Looking forward to hearing more about what has been said. Caroline, thank you very much indeed. Caroline Hyde on what's happening with the US retail story. Let me just tell you about what's happening in the UK retail story. Looks like Marks & Spencer, after the recent rally, the incredible rally that's seen this year, is going to be re-entering the FTSE 100. Diploma probably look like it's coming in as well. But M&S has been on such a tear recently. It's amazing to see that happening. So a positive retail story. It is about that revamping of the business going forward. Unsurprisingly, Alex, we're seeing Johnson Matthey coming out. That's a chemicals company. Also a sustainable technology company, actually, which is interesting. Persimmon also going to be coming out. That's one of the UK big house builders. Unsurprisingly there again, given what is happening with the market, it's going to be dropping out. But it's interesting. House builders out, retailers in. Yeah, I feel like that's a PMI manufacturing versus PMI services. Like if I just boil it down, I feel like that's what we're seeing, that gap. Yeah, the consumer continues to spend. And I think that's been the thing that even here in the UK has confounded everybody. And you talk about the savings that exist in the United States and how they've been maybe drawn down. Hasn't happened to the same degree here. No. And the consumer continues to spend, and the wage gains that we're seeing are substantial, and that continues to prop up the consumer as well. It is being obviously eroded by what we're seeing on the rate story, but that is not true for everybody. But as Caroline was just saying, at least here in the US, where in some stores you're starting to see that credit card usage pick up. We're still in that, as she was mentioning, like that good phase where it's like a good buildup of credit. We're not going to see a lot of delinquencies, but like once you, like what is that tipping point? I mean, at some point you just spend too much and then something happens, you lose your job, you get lower pay and then you can't pay it. Like that tipping point's very dicey. It's the labour market. It's the labour market holding up. That's the critical factor. People can re-gear. Their balance sheets were in great shape. They have the capacity to re-gear without stressing that balance sheet too much, assuming that the labour market holds up. And that's towards the Fed on Friday. That's the narrative. How high do yields stay? How much damage needs to be done to the labour market in order to bring inflation potentially back down to 2%? That's the story. This is Bloomberg. Losing some steam at this point. Abigail is tracking these moves. Abby?
Yeah, folks probably wanted 3 up days in a row for the S&P 500. Right now, at least, it's not happening, but small declines, some hesitant trading action. And Microsoft, which had been up more than 1% earlier on the rework deal to please the UK for Activision, that $69 billion potential buyout, well, it's off of those highs, but still one of the gainers. Nvidia, on the other hand, down 2.8% ahead of earnings tomorrow. Options suggesting a 10% move after those options, either up or down. down. Now, this is the NASDAQ in the month of August, so this is what we're looking at, down about 6%, almost 6%, 5.5%. The worst month of the year. A nice bottoming pattern here. On the other hand, the downtrend is completely in place here. It's going to be interesting to see how the rest of this week goes, and nothing really to look at except for, of course, Jackson Hole. I'm kidding, because that is a big one, especially when we take a look at this. We've been talking about yields over the last month with that 10-year yield coming up about 50 basis points over the last year. It's almost unbelievable, but you have this 2-year yield up 1.7% and the 10-year yield up 1.3%. Let's tackle the end of the bond bull market, and is there a start of a bear market in bonds? Well, here is the bull market as yields go down, down, down. We've looked at this a number of times over the last few years, and when we were here, the question was, are we going to go back down in the range? Even if when we were here, the question was when we were going to go back down in the range. Now that we're breaking out of that small area of congestion, it may not happen right away, Guy, but this chart suggests that we could actually see yields go significantly higher, above, actually I'm not going to name levels, but significantly higher with time.
One William Dudley addressing that very issue in a very nice Bloomberg opinion piece earlier today. Abigail, thank you very much indeed. You can see it. It's a great read. Honestly, check it out. What are we watching for the rest of the day? We're certainly not done. Talking of the Fed, we've got 2 Fed speakers later today. Chicago Fed President Austin Goolsbee, Michelle Bowman's going to be speaking. And of course, we get Zoom and Toll Brothers after the bell. This is Bloomberg.